The topic of this lesson is exchange rates. We will explore the types of exchange rate systems. At the end of the lesson, you should be able to explain the different exchange rate systems. In addition, you should be able to differentiate between depreciation and devaluation, and between appreciation and revaluation. What is exchange rate? It is the price or value of one currency in terms of another. It shows how many units of one currency can be bought with a unit of another currency. An exchange rate stated as $1 equals 500 pounds indicates that a dollar can buy 500 pounds. A currency usually has its exchange rate with many other currencies, for example, dollar to pound, dollar to euro, dollar to yuan, etc. Foreign exchange market. This is a market for the sale and purchase of foreign currencies. The foreign exchange market is not a single location. It is a global network of commercial banks, central banks, other financial institutions, multinationals, individual investors, and brokers. The demand and supply of a currency determine its exchange rate in the market. There are two major types of exchange rate systems, namely floating exchange rate system and fixed exchange rate system. There is a third type which combines the elements of the two. It is known as managed float. Floating exchange rate system. In this system, the exchange rate is determined by the market forces of demand and supply. The exchange rate fluctuates, and there is no intervention by the government or the central bank to influence the rate. This system may discourage investment because the exchange rate is not stable. It fluctuates when demand or supply changes. However, the government does not need to use its foreign currency reserves to intervene in the market. Depreciation. A fall in the value of a currency in terms of another is called depreciation. There are two major causes of fall in the value of a currency, namely fall in demand for the currency and increase in the supply of the currency. This is similar to what happens in the product market. When fewer people demand for the product, its price falls. When there is an increase in its supply, the price also falls. A fall in currency demand due to less demand for a country's exports, for example, causes depreciation. Demand for the domestic currency decreases from D1 to D2. The exchange rate declines from P1 to P2. The quantity decreases from Q1 to Q2. A rise in the supply of domestic currency as more people try to import goods from other countries causes a fall in the price of the currency. People sell the domestic currency to obtain foreign currency to pay for imports. This will increase the supply of domestic currency from S1 to S2, leading to a fall in the exchange rate from P1 to P2. The quantity of domestic currency increases from Q1 to Q2. A rise in the value or price of the currency is known as appreciation. This is caused by either a rise in demand for the currency or a fall in the supply of the currency. An increase in currency demand, owing to more demand for a country's exports, for example, causes appreciation. Demand for the domestic currency increases from D1 to D2. The exchange rate rises from P1 to P2. The quantity increases from Q1 to Q2. A fall in the supply of a domestic currency due to a reduction in importation causes a rise in the price of the currency. This will reduce the supply of domestic currency from S1 to S2, leading to a rise in the exchange rate from P1 to P2. The quantity of domestic currency decreases from Q1 to Q2. A fixed exchange rate system. The government or central bank maintains a fixed value for a currency against other currencies. The exchange rate is not determined by the market forces of demand and supply. There is stability in the exchange rate which encourages investment. However, if it is too high, exports become very expensive while imports become very cheap, leading to less exports and more imports. To maintain the stability in the exchange rate, the central bank or government purchases or sells the currency. The government uses its foreign currency reserves to intervene in the market. government intervention in a fixed exchange rate system. Assuming the exchange rate is pegged at P1, a rise in importation will increase the supply of domestic currency as people sell it to obtain foreign currency to pay for imports. Therefore, the supply of domestic currency increases from S1 to S2, causing the exchange rate to fall from P1 to P2. The government will intervene because the exchange rate, P2, is now less than the fixed value of P1. The government will buy the domestic currency to increase its demand, leading to a rise in demand from D1 to D2. The exchange rate is now restored to P1. Devaluation and revaluation in a fixed exchange rate system. If the value of the domestic currency against other currencies is reduced by the government, it is known as devaluation. A rise in the value of a domestic currency against other currencies caused by the action of the government is revaluation. A managed float exchange rate system. This is a combination of the two major types of exchange rate systems, the floating and fixed exchange rate systems. Here, the government selects upper and lower limits for the exchange rate. It will only intervene when a change in demand or supply will make the exchange rate higher than the upper limit or lower than the lower limit. In other words, fluctuation is only allowed as long as the exchange rate is within the established range. There is a fixed range, and the exchange rate is not allowed to move out of it. The government requires foreign reserves to intervene when necessary.